I should be back up on YouTube with a little bit of a different stream there. I think. YouTube and I'm gonna bail on the Twitter. If anyone's able to confirm that, I would appreciate it. Okay, yep, new stream up on YouTube. Just because this is technically a different stream, I'm just going to reread the disclosure here, and I apologize about the technology issues. I'm associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA/SIPC. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. And there is the position disclosure. Turn my camera back on. And let's go back to the charts. All right, so again, I apologize. We're on a different stream here on YouTube. I got to speak to the tech team because they've been trying to have me use this different software that can allow me to broadcast to more than one medium at the same time. So right now I was on Twitter and YouTube and the VTF all at the same time, and potentially could get on TikTok and a couple other things at the same time. But we are experiencing technical difficulties with it. So should be up on YouTube now, and let's just kind of get right back to it. So like I was saying, the morning meeting today was a little bit of a less is more approach. I really wanted to just kind of be in wait and see mode for the market today, and that's what I did. So I was able to eke out a few bucks for myself today, have it be a green day. Nothing to really write home about, but considering that it was a really difficult, choppy day, look at the SPY price action on the 5 minutes, just gross. I'll take whatever money the market will give me. Q's here also ending the day with kind of an uncertain doji, and our IWM overall has been given good relative strength. So we'll see if the IWM can actually give a little higher low here off this $200 area. There were a few names that I was looking at this morning, and I actually didn't get into any of them. But we can take a look. I was looking at Micron this morning off the upgrade, kind of versus yesterday's low, and then it gave this really nice inside 5 and up. That was a decent opening drive trade. Eventually failing, just kind of with afternoon market weakness. I was looking at DKNG through 24, but it never triggered. So if a trade idea never triggers, then there's kind of no harm, no foul there. We talked about energy needing to take a break. And that's what we got. XLE was actually very relatively weak this morning, which is interesting because USO closed green and UNG was actually really strong. Natural gas is up 4.5% today. But these energy stocks were a little bit overbought coming into today, so they showed some relative weakness. They showed some further cooling off, which is not the end of the world. And if you're a believer in the sector, if anything, it's a potential buying opportunity, further kind of building out this flag. But the fact that you've got XLE down 2.5% while oil is up, USO is up 0.75% and UNG is up 4.5% is a little bit bizarre. But this was another one that was definitely beholden to what was going on in Russia, because market expectations are that if that war were to happen, that the price of gas and oil is going to go up a lot. And somebody here in the VTF, I don't remember who it was, said, hey, this is kind of interesting that UNG is up so much today, that natural gas is up so much today, that maybe the natural gas market is kind of foretelling something happening here in Russia that the U.S. equity market is not necessarily foretelling in the same way. So I thought that was a really interesting point. We'll continue to monitor that. But XLE totally cooled off. Apache managed to barely hold on to that $32 support that I want to see it hold. That is not a good candle from Apache, but I do still have a position on it. And you look at another name like Oxy. Oxy's been very relatively strong, was very extended after Friday's trading session. It's actually just a wide-ranging inside day today. ExxonMobil, a little bit more relative strength from this stock. Maybe it's considered to be a little less speculative than an Oxy or an Apache, but it's just down 1.7% on the day. So those were all on the radar, but as we kind of correctly thought in the morning meeting, they did turn out to be relatively weak today. They cooled off. So once again, no harm, no foul. We spoke about Amazon long off 3,000. You had to kind of pay up in order to be able to get some stock on that, and you had to do it right at the open. But if anybody paid up on that, it turned out to be probably one of the better trades on the day today. I know a couple of you guys were focused on AMD. I didn't love this AMD that much because I think that the daily chart here is a problem. I mentioned if you start getting into this 120 area, it's going to be an issue. AMD just with a gross daily candle on Friday, NVIDIA as well. But I think we have NVIDIA earnings this week, so maybe we just need to stay away from AMD and NVIDIA until we get a little bit more clarity. And that was pretty much all that was on my radar. One that was not on my radar that I ended up trading was this BKKT. It ended up being like basically a break-even trade. Very small negative for me, and I actually cheated on it. So the real trigger that we discussed in the morning meeting was above yesterday's high, which was $7.85. It never actually triggered above $7.85. And honestly, the volume maybe didn't even justify my cheat, but I thought that the price action here was pretty good. It was trying to act strong early on. There was an uptick in volume, so I got involved in this early. I forget my exact price, $7.50 or so, something like that. I was just using the second bar low as my out, $7.29. I actually got some slippage on that out, which is probably the reason why I'm small red in it, as opposed to just being break even, because I was able to get my kick on the way up here to kind of cover my risk, and then that one eventually failed on me as well. So that's pretty much it. I don't really have anything else to talk about. Really difficult trading session today. So I think that, one of my big, just to talk about, I guess, one more thing here. One of my big themes in trading, for trading success, and it's a really important one, is knowing when to be more aggressive and knowing when to be more passive in your trading. When the market lines up and all the stars and the sun and the moon are lined up, your trades are all there, you got these A+ setups, you have to be aggressive when you have the advantage or you're not going to make money in the business. But not every day is equal. Some days are going to be those great days where you need to be super aggressive, and other days are going to be the opposite. And that's what today was. When you come in and you look at the market and you can say to yourself, you know what, I just don't feel like I have a strong advantage. This market feels like a 50-50 coin toss today based on where we're opening, on how we're going to move. The smartest thing you can do in that situation is to take a step back and trade very little. Because if you overtrade when it's difficult, if you overtrade when the opportunity is there, it's a recipe for losing money. And if you undertrade when the opportunity is there, sorry, did I say that right? If you overtrade when there is no opportunity, it's a recipe for losing money. And if you undertrade when there's a ton of opportunity, you're never going to get paid. And you really need to have that balance. You got to get paid when the opportunity is there, and you have to preserve capital when the opportunity is not. Today was one of the latter. And it was just a choppy day with those headlines hitting all day. So if you traded less today, you did a good job. If you traded, whatever your average volume is as a trader, maybe it's, 50,000 shares. Today maybe should be a day where you traded half that or even less than half that. And then maybe we'll get another day in a week or later this week or something where it's the opposite, and you should be trading double your average volume because there's so much more opportunity that's out there. So it's worth knowing kind of what your average volume is as a trader, because you can utilize that information to assess whether or not you're doing a good job. And I think that today doing a good job would be to trade less. Oh, thanks, Dylan. Dylan giving us a little YouTube video here from Derrick the Trader, buying passive versus aggressive in the market. All right, cool. So that's all I got. Happy to answer any questions that you guys are looking at. From Diego, kind of a comment. Famously, Winston Churchill defined Russia as a riddle wrapped in a mystery inside an enigma. And his words in 1939 spoke eloquently to the Western sense of Moscow as the other. An inscrutable and menacing land that plays by its own rules, usually to the detriment of those who choose more open regulations. Just looking for questions. I'm not seeing any questions. All right, from Steve. My second best trade today was shorting 100 shares of Tesla at 145. Tesla also had a pretty bad candle here on Friday, right? Was building out this wedge pattern. I would call this wedge pattern that Tesla had like a neutral pattern, neither bullish nor bearish, but it broke it to the downside on Friday. I guess just because of the market weakness. Today was a little bit stronger. I guess it's an inside day today for Tesla. But let me look at your execution. So Tesla was actually relatively strong intraday today at one point. So that makes me a little bit more nervous. But your timing on the short is solid. You could define this as a short time frame bear flag coming in here at 145, and it looks like you're shorting the break of that bear flag, which is a good technical 5-minute trade here. And I would call this a bear flag because it is, at least on a very small time frame, trending down into the consolidation pattern. And then right as the ADMA catches up to the high of the flag is when you get continuation. So that's technically perfect. Got your 1-to-1, sold more at 2 p.m. Okay, nice, good job. And let the rest roll until you got stopped out. Yeah, so I don't dislike it. I don't love it either. You definitely have a trade. You have a real trade there. You recognize that the market was getting weaker. You recognized a bearish pattern in Tesla, and you took advantage of it. So I love all that. What don't I like about it? I'm not crazy about the time of the day that you're putting the trade on. And I'm not crazy about the fact that it was relatively strong early on in the day. So it's not something I would characterize as an A-type trade, but is certainly something that fully meets our definition of a trade, and you executed it properly, and you game planned it properly, you got your risk covered, you booked a little bit more, and then you held some for continuation until you got stopped out because you were trailing it. So your game plan is great. Trade is like a C+, B- trade is kind of where I would rate that from like a letter grading type of situation. Larry doesn't have any questions today, but he's new and is happy to be a part of T3. Awesome, Larry. Welcome. Welcome to the team. Question here from YouTube from Canon. Does ATR help with determining the end of a trend? That's a great question. I don't like looking at ATR because if you're really so what is ATR, right? ATR stands for average true range, and it is the average range in which a stock typically trades in a day. And they typically go back, I believe, 3 months. I think that the average number that is usually posted in like a Yahoo Finance is like a 3-month ATR, I think. Could be 30 days, but I think it's 3 months. So I don't like looking at the ATR because if I'm really trading a stock on the right day, I want to be trading it on an outlier day. So an average true range is just an average. So maybe this stock moves an average of $1, just to keep easy numbers. Maybe whatever stock you're looking at moves an average of $1. But it's just an average. So there's going to be outliers. There's going to be a day when it only moves 20 cents. And there's going to be a day when it might move, $2.50. If I'm really focused on trading stocks as they're in play, which is what I prefer to do, then most likely the range on that is going to be larger than what the average is. So looking at the average can actually be a detriment to you because you could say, maybe you're in from a great price, and today is the day when it's going to move $2.50. And as soon as you see that it's moved $1, you're like, all right, I'm out of my position because it moved the entire ATR. So that's why I don't like looking at that statistic very much for my own trading. And also because if maybe today the stock does only move the average, but I bought it really well. The average is $1. And I bought it 10 cents off the low. I caught a 90-cent move. it moved the average, but it's closing really well, and the daily chart looks really good. So that could be a position that I now have as a swing trade, and I get further continuation through the following days. I make that next dollar the next day and the next dollar the next day as I catch like a day 2 or a day 3. So I don't like looking at ATR. I find the statistic to be a detriment to traders trading, and I don't recommend it. But it was a great question because I know people are curious about it. From Tommy Pham, is the T3 Pristine method the course I would buy to learn the foundation of trading, or it is an add-on? You would have to reach out to the folks at T3 Live to get a direct answer to that question. Personally, when I'm referring to my training program, I'm referring to my training program. I think in T3 Live they call I just call it the training program. I think they call it the boot camp or something like that over at T3 Live, the Pro Trader Boot Camp, something like that. That's what I would definitely suggest that you look at. It starts very basic but advances very quickly, and I'm biased because I created it, but I think that it provides you the tools that are necessary to get a really good jump start on your trading. All right, is that it? Oh, just one from Aaron. Derrick, you said once that it is very difficult to be a day trader and swing trader at the same time. I don't remember saying that. Not impossible, but very difficult. Could you clarify why you believe that, and if we should choose one or the other at some point, hybrid possibly? Yeah, I don't recall saying that because I do both. So I don't know why I would say that if I actually do both. I day trade and I swing trade. A lot of what I like to do is have core swing positions that I actively day trade around for cash flow. I find, and I started my career as a pure day trader. My first probably 3 years at T3, I don't think I kept a single position overnight. It was also a very different market environment at that time. But since then, I don't think I've gone home flat. I probably haven't gone home flat in like the last 5 years. So I find as my trading career has advanced, I personally have found day trading to be profit limiting. So I love to use day trading signals as entries, but if the position closes really well and the daily chart is great, and you just exit the position at the close, you're potentially limiting your reward. If you're already in that win-win situation, you're up a lot of money in it, why not keep a percentage of your position as a swing for further follow-through? So I actually would say the opposite, Aaron. I'm a big believer in combining day trading and swing trading. Now, maybe what you're confused about, or maybe you misheard me, is I do think that if you're a brand new trader, you're better off focused in like your first few months as a brand new trader more on the day trading side of things. Because if you're trying to trade purely based on daily charts, you're just going to be putting on a lot of risk. And what I like to do is, I think you and everyone knows, is I like to find intraday risk on a 5 or 15 minute chart for daily chart reward. That's my ideal situation that I'm really looking for. And that's going to give you fantastic risk reward scenarios for when it actually plays out. David M, what's your question? You want me to talk about GLD, or if you could just copy and paste your question, I'm happy to take a look at it. Yeah, so this is interesting how well gold held up today. So gold having a huge rip higher on Friday makes plenty of sense to me. I think especially in times of war, you know, having gold and silver is something that you want to have. And the market seems to agree with me. You know, Friday was very much one of those de-risking type days. The equity market sold off, the bond market caught a bid, and gold caught a huge bid. So that's classic kind of de-risking. Now the interesting thing about it is this morning when Russia was kind of coming out and saying that they were doing no invasion, that gold didn't retrace a large percentage of Friday's up move. It held up great and actually closed really well again today and gave further follow through. So GLD is looking stronger to me than it's looked in quite some time at this point. The technicals on GLD have been sloppy since this high in the summer of 2020. And by the way, we caught this move. We caught this move in the gold miners. It was like one of my best trades of my career, actually. But since then, I've been staying away from it. Gold itself has been super sloppy. The gold miners have been super sloppy. But this is interesting. Big wake-up bar on Friday. Gold is now back in bullish territory as long as it does not lose Friday's low. I don't like trading GLD too much. It's very gappy. I prefer to trade these miners. So we want to look at GDX for that. And the GDX chart has also been very sloppy since gold topped out in the summer of 2020. You can just see that. Look at the choppiness and sloppiness of this chart. No clearly defined trend. But once again, you have a major ignition wake-up candle here on Friday, and Friday's low is going to be really important going forward. Though I would say that overall it's in this kind of broader chop. It's coming back down. It's coming up to a descending 200-day, which isn't fantastic. But this is definitely something that we want to keep an eye on. So similar to whoever in the VTF this morning or earlier today remarked about how maybe natural gas here is actually still, the natural gas market still pricing in a Russian invasion of Ukraine. It seems like the gold market is still also pricing in a Russian invasion of Ukraine. So let's definitely continue to keep an eye on that. Big day for that on Friday. And AEM you're asking me about specifically. Yeah, AEM getting above 50 looks better. Overall still sloppy. Your next resistance level would be at 54. Cool. So Steve's question about is asking me about the reason why I mostly day traded. It wasn't because of buying power. It certainly wasn't because of buying power. It had to do with a number of factors. First and foremost being that the team that I was first recruited into was specifically a day trading team. Really no one on the team that I was kind of trading alongside held positions overnight. So that's just kind of what I got indoctrinated with early on in my career. But it was also a different market environment. It was a market environment where reading tape was significantly more useful than what I think it is today. And there was just these movements in the market that made, there was just opportunities in the day trading environment that just don't exist. There were certain types of trades I used to take back early on in my career that I don't teach people anymore because they literally don't exist. There's no point in teaching somebody something that just doesn't exist. So that's really the extent of it. The team I worked on actually kind of frowned on keeping overnight risk just because, you never know what's going to happen overnight. And I get that. And I frown on people taking overnight risk as well if they don't have the profit cushion, right? That's what I'm always preaching. Take the overnight risk when you're in a win-win situation. Take the overnight risk when you have a profit cushion. Don't take overnight risk because you bought a position, the position closed against you, and you're hoping and praying that the next day the market's going to gap up and bail you out of your trade. That's a great way to lose a lot of money. My approach now recognizes the added reward benefit of swing trading, but also has rules to mitigate the added risk of swing trading, if that makes sense. From ET here, to your point on actively trading around core positions, doesn't that change your average price? And does last in, first out, or first in, first out have any impact on your average price? Am I overcomplicating? Yeah, I think you're overcomplicating. Play with the math. I think someone asked me a similar question recently. Play with the math on it. So let's say that you bought 1,000 shares of a position at $100. Just trying to keep the numbers here really, really simple. And you sell 500 shares to just at 1-to-1 to cover your risk, whatever. You got 500 shares left. And generally when I'm implementing that approach of actively trading around a core position, I want to have a very large core position so that if I lose some stock, it doesn't really matter to me that much. But again, let's just try to keep these numbers simple. So now you got 500 shares left. Stock goes up to $101, you take 100 shares off. Now stock comes back down to $100.50 and you rebuy that 100 shares. is the software showing you that you still have an average price of $100? No, it's not. The software is showing you that you're going to have an average price of, I don't know, $100.10 or something like that. Because you had 400 chairs and now you're adding 100 chairs at $100.50. Whatever that average turns out to be, it's going to be above $100. So you increased your average price. But if the thing goes down and stops you out, did you have a worse average price, but as you get stopped out, did you make more money or did you make less money? Right? You made more. Even, or how about this? Let's think about it this way. Not that you would ever do it, but just thinking about it from the math perspective. You buy that 1,000 chairs at $100, you sell 500 chairs, you have 500 chairs left. Let's say you sell that 100 of your remaining 500 chairs at $101, and then let's say you rebuy that 100 chairs at $101. So you sold 100 chairs at 101, you rebuy 100 chairs at 101. Is your average price now higher than $100? Yes, it is. But if you go down and you get stopped out, is the amount that you're losing different? No, the amount that you're losing is going to be the same. It's going to be 0 if you did the 50% of your position at 1-to-1 kick. So average price doesn't matter to me, is basically what I'm saying, because it doesn't actually affect the math of my risk and my reward. So again, play with the numbers, and that's what you're going to end up finding out. So I don't care what my average price is. I don't really care, you know. Sometimes if I'm selling a position, it might give me a little negative P&L symbol there, like I just lost money on that sale, but I know I didn't. I actually made money on that sale, but it's calculating it based on average price, and that can be a little tricky sometimes. From YouTube, Naveen, would you consider taking trades out of bull channel or bear channel? Example, would you short if a bull channel is failing, or would you go long if a bear channel is breaking out? Sure. So basically what you're talking about is taking the opposite side of technical patterns, and I'm not necessarily against it, but I don't love it either, and I'll just tell you why. So there is a common saying in trading: from a failed move comes a fast move. And I'll do that myself. If I see that there's a bear flag as an example, and that bear flag breaks to the upside, I might buy some stock on that break. Especially if I have other layers of probability that are telling me that that bear flag could actually break up. So I will do that. But I would also say to you, don't overcomplicate your system. You know, if it's a bullish pattern, it's a bullish pattern. If it's a bearish pattern, it's a bearish pattern. Maybe that pattern fails, or maybe you're overreading things. So I'm a big believer in the acronym KISS. Keep it simple, stupid. Not calling you stupid, just telling you the acronym. Again, not against what you're saying. You definitely have a trade there. From a failed move comes a fast move. Just be a little bit cautious that you're kind of overcomplicating your approach to trading. From Sebastian, I know that relative strength in, I'm assuming you mean pre-market when you say PM, is easy to see and identify, but wanted to ask how much attention should we pay at this along the day? Like relative strength changes that occur at the afternoon or in the last hour of the day. Yeah, you do have to pay attention to that. So relative strength and relative weakness certainly flips sometimes. And especially you'll often see it flip at the open. Sometimes, you know, the IWM is relatively strong to the NASDAQ pre-market, and then all of a sudden, like at 9:32, all of a sudden that's flipping. Right, the Qs are catching a big bid, and the IWM is relatively weak, and the NASDAQ ends up being relatively strong all day. So relative strength and relative weakness is definitely a dynamic layer of probability. It changes, and it also varies based on the time frame in which you're looking. So you have to kind of stay in tune with what it's telling you. You know, sometimes you'll see something that's down more on a percentage basis than something else, but actually intraday is acting stronger. Intraday, it's acting stronger. So, again, and that could just because it gapped down really big. Something gapped down really big, but it's actually trading better off the open than something that gapped down less. So those are all nuances of relative strength and relative weakness that you have to pay attention to. From Policing Pips, I like the name. When you combine the swing with a day trade, how are you structuring that? Are you buying a full position and then taking off only some during the day and leaving a majority on for the swing? So it certainly depends on the type of trade that I'm taking. For example, am I with the trend or am I against the trend? Those are two very broad types, and then obviously there's many types of with trend trades, there's many types of counter trend trades. But I tend to be more greedy from a game planning perspective if I'm with the trend than if I'm against the trend. So if I've got a trade that starts, as a day trade or whatever it is, and I'm with the trend on every time frame, I might end up swinging 50% of the position. Whereas if I am taking this counter trend, I might only end up swinging 10% of the position. So the type of trade definitely is the big factor on that. I'm just rereading your question here to see if I missed any points. Are you buying full position? And then it also depends on the type of trade on if I'm taking the full position all at once as an entry. If I am buying a momentum trade, if I'm buying a breakout as an example, which is a type of momentum trade, I'm almost always taking my entire position at one shot in that case. As opposed to if I'm building into a position off a support level, that might be something I build into over time. I'm not taking all my stock all at once. I have a game plan that says, all right, I'm going to pay up this amount of money on this percentage of the amount of stock that I would like. And if it just goes from there, fine, I've got some stock. But if it gets closer to the level that I'm paying attention to, I can build in more and kind of get heavier. So it definitely depends on the trade. That's a great question there, Policing Pips. Glad you're tuning in on the YouTube. From Dalek here, what are your rules to move from a day to a swing trade? How much is your cushion? I call it the 1% rule, and it probably should be the 1% guideline. I call it the 1% rule, meaning that generally I always want to be at least 1% in the money on the position that I have in order to keep it overnight. And again, this is just to cushion from overnight events. One story I like to tell every once in a while is I was trading a company called Chihu 360. It was a Chinese ADR that has since been privatized or something, so it's no longer in the market. The symbol was Chihu, Qihu, I think. Man, did I crush it one day on this thing. I absolutely crushed it. I caught the trade perfectly. News came out. I think I caught a 16% intraday move on it. Absolutely crushed it. And I probably kept 20% of my position as a swing, something like that. And went home that night elated about how much I crushed that thing, and I still had a position. It looked great. That night they announced an accounting scandal. The next day the stock gapped down 16%. It gapped down the entire move. And I came in the next morning and I was like, okay, gave that all the way back. The point is, and that's an extreme example. Stock gapping down 16% on an accounting scandal, right? Luckily, on that trade, I think I still made money because I only swung 20% of my position and I had a profit cushion that exactly matched the amount in which it gapped down. So you keep stock overnight when you're thinking that you're in a win-win situation, recognizing that you have overnight risk. This, by the way, is why I don't like trading biotech companies. It's always the biotech that gaps up 300% or gaps down 95%. And as much as I would love to be swinging a position and the next day I'm 300% in the money, that's never happened to me. I could potentially blow up my entire account if I was swinging a position and it gapped down 95% against me. So that's why I'm not a big fan of swinging biotechs. So I call it a 1% rule or 1% guideline where, I close 1% in the money and it happens to be that the market itself gaps down a percentage point the next day, which in this market environment has been happening a decent amount. And, I just gave back my open profit. I'm not in trouble. But honestly, it depends on the stock. Some of these high beta names, these growth stocks, 1% is probably not enough. These things are moving 5% every day. So it easily could gap down 30% against you. And if that puts you in a bad spot, that's no good. So it's a 1% guideline, but, just recognize the type of stock that you're involved in. Nice ET. From Terry Jones, if you could give your insights on Q's, AMD, Micron versus Chevron, Exxon, can both industries trend up, or are we in a market cycle where energy leads? Well, we're definitely in a market cycle right now where energy's been the leader, that's for sure. But can they both move up together? I'm a believer in the answer to that being yes. I think that it's possible for some of these growth stocks, which are down 75% but still at historically high multiples, to hold up while energy leads the market higher. And my thought process on that is based on where we are in a tightening cycle. Even if we get 4 or 5 interest rate hikes and the interest rates go from 0 to 1%, 1.25%, something like that, it's still historically very easy monetary policy. And easy monetary policy enables multiples to trade higher than they would otherwise. So if you're looking at, I know you asked about AMD and MU. AMD and MU are a little different than some of these hyper growth stocks that were trading at insane multiples. And if anything, AMD and MU can hold up even better in a lot of ways than like a Palantir or a Robinhood or a Fubo or DKNG, something like that. But I've been of the opinion that they can work together while we are in a tightening cycle. You know, companies that make money are kind of where you want to be, and we're definitely, you can see that in the charts of your Chevron and your Exxon and your XLE. That's been what's leading. AMD is definitely a little bit more of a high multiple play. I think we stay away from AMD until we get through NVIDIA's earnings, and I also hate Friday's candle, so technically right now AMD looks a little bit broken to me. But Micron looks great. Micron is a little bit more, has a little bit more value to it than an AMD or a NVIDIA from a multiple perspective, I think. If someone wants to fact check me on that. I know that was definitely true when Micron was trading as a $50 stock. I remember trading a lot of Micron back when it was in the $50 range here, back in like 2020. I've been trading less of it at $90. But I think that there's room for both. No problem, Steve. From Cools, been following your keep risk in check and have been putting tight stops on my day trades. I've been getting stopped out only to see the trade move higher. It's so frustrating. What's the rule to that? Sure. So tight risk or keeping risk in check doesn't necessarily mean tight stop losses. It more means dollar risk in a lot of ways. You know, so if we're in an environment where it's less is more, like kind of today's trading session was, and I'm not seeing any A+ trades, it means less dollar risk, right? Because you can take, you know, again, just using simple numbers, you could take a 1,000 share position and risk $100 in it because you're risking 10 cents. Or you could take a 200 share position and risk the same $100 by giving it 50 cents room, right? Or 400 shares and give it 25 cents room. You're still risking the same $100. So that's kind of how I want to structure it. When it comes to choosing your stop losses, the market chooses the stop loss for you, right? The market tells you, based on technicals, you should be using this pivot low as a stop loss. You should be using this ignition bar low as a stop loss. Things like that. And I'm always trying to utilize the stop loss where I know that my idea was wrong. So actually, the longer I've been in this business, the more I've preferred using slightly looser stops to slightly tighter stops. Which isn't to say that I don't ever take a 5-cent risk trade or a 10-cent risk trade and take a ton of size on it. I will if the market's telling me it's okay to risk 10 cents in it. But as another general rule, and this is an important one for this market environment that we're in right now, As volatility elevates, you need to take less tier size for more space risk, right? And then as volatility tightens, then you take less space risk and you take more tier size. So it sounds to me like if you're getting stopped out of things and that your trades are still working, first of all, it's a good problem to have, because that means that your ideas are generally right and your execution is the problem. So you just, your ideas are right. You just need to improve on your execution and where your stops are. So maybe try taking a little less size, giving a little bit more space, and utilizing that spot on a 5 or 15 minute chart where it's a pivot low or it's a ignition bar low, where my idea itself is actually wrong if my stop is triggering. So I hope that helps. And that's also a great question for this type of market environment. Let me look at your Micron example here. I had MU at the low. You bought at 89.10 in MU? You bought at 89.10. And you got stopped at 89.95, 88.95. Is this? You wrote 99.95, but I don't think that you wrote the right price. So you bought 1,000 shares at 89.10. Somewhere in this area here, between 1 and 2. It's always helpful, and I'm always happy to look at anyone's specific trades here in an afternoon meeting. But if you can give the price in conjunction with the time, it helps me to be able to look at the specifics of the technicals on where you purchased. But I'm assuming that what you're saying here is that you bought at 89.10 with the stop at 88.95, and you got chicken out of it at 2 p.m. What were you using your stop loss off of? Were you just using Friday's low? Is this yeah, you probably were using Friday's low because we discussed in the morning meeting, right? We discussed going long versus 88.95 as a stop loss. So that's definitely the right stop. I don't like the time in which you're buying it, though. Based on the way that this thing traded in the morning, this stock never should have been even getting below $90 again. So the fact that it's the afternoon, it's 2 o'clock here, and it's getting below $90, that's a problem. I would rather, and it sounds like you risked $150 in it, so it's a little bit wonky, I guess, in terms of the execution on the dollar amount. I would have rather you have been buying it somewhere earlier in the day versus that stop loss, but having significantly less stock. Or a lot of the times what I'm doing in the morning meeting, and this is important for me to go over as well, is I don't know what the intraday chart looks like pre-market, obviously, right? So the analysis that I'm doing is based on the daily chart. And I can tell you here, based on the daily chart, I like the idea, pre-market this morning, of going long Micron versus yesterday's low, which is 88.95. But now we need to adjust to the trading price action as it occurs. And the trading price action gave us this great early setup. So big picture, Micron looks decent here as long as it's maintaining a price above 88.95. And now I have a 5-minute trade here that looks great. So you could have purchased, using the inside candle here, inside candle execution trade is what we kind of call this. You could have purchased on the third bar of the day at 91.61 versus the low of the inside bar of 90.59. So it's still about $1 of risk, So but again, for your $150 worth of risk, you're taking 100 shares, 200 shares, something like that. So it's a decent amount of risk. But the big picture is telling you that the spot is still right, and the small picture is giving you this tighter execution. Because if this thing was really going to go, if this was really going to work today, fine, maybe it pulls back here midday. It's not that unusual, but it really should never be getting below this like $91 or so. It definitely shouldn't be making new lows in the day. So I would argue that we want to combine that smaller time frame for execution based on what we like from the bigger picture. And what I would say that you did here was you've got that bigger picture. You're doing that properly. You're trading versus yesterday's low, which is exactly what we spoke about in the morning meeting. But you're doing it in a time when the smaller picture is telling you that that trade isn't right in the same way anymore. The smaller picture, this stock definitely never should have gotten below 90. Definitely never should have gotten below the opening low. That in itself is telling you that something is wrong. What is this something that's wrong? I don't know. Maybe it's the market, right? Because the market was super choppy today. This was probably one of the periods of the time today when the market itself was weak. Let's take a look. What did the market do at 2 o'clock? Yep, this is exactly when the market was weak. So the market was kind of causing this Micron to fail after it tried to be really strong off the open. So that's kind of a lot of what I'm doing, and that's the information I want people to take away from the morning meeting also. You know, the morning meeting, I'm exclusively talking about daily chart entry prices and daily chart stop losses. But a lot of times you want to take that information that's from the daily chart and recognize what it means, and then apply it onto the smaller time frames for execution. Because we know that this 88.95 is really important, which is going to be yesterday's low. But now you're like, all right, it's holding in really well. Look, it's breaking, it's going really well, especially at highs. You're probably pumped about how this Micron looks at highs today. Tries to create a higher low here, but then fails to make a higher high. This thing was looking solid here. And I think I called out actually another trade in Micron off this candle as it was forming. So this would have been a second opportunity. And this one would have failed, but it would have been a big enough of a move. I think some people took it to get your risk covered. So I think I called out like a buy at about 91.90 versus this low of 91.65. So that's an even, like, this inside 5 trade here is like $1 of risk. This is even much less than that. That would have been, like 30 cents worth of risk. And again, it eventually failed, but it gives you a big enough of a move to be able to, cover your risk from a game planning perspective before the trade itself actually fails. But now if that trade doesn't fail, right, if you've got stock from this break or you got stock from this potential lower high, and now this thing is breaking its inside day, this thing's getting above 94.50 and it's, closing at, 94, 94.50 on the day today, you're probably looking at a daily move up to $98. So that's kind of what I'm talking about, where it's like pre-market we're analyzing these, bigger picture spots, but then you need to execute based on that smaller picture. And what I'm looking for is daily chart reward for smaller time frame risk. I know that if this daily chart plays out properly, that this stock could be seeing $98. But does that mean that I'm looking to buy 94.50 with a stop loss of 88.95? Certainly not. I'm not coming in and risking $5.50 of risk or whatever that is for $4 worth of reward. But if I think that this thing can give that move to 98 based on that bigger picture, as long as it doesn't break this low, and then I can come in and I can find a spot where I'm risking $1 or I'm risking 30 cents, now all of a sudden, let's say I get that move to 98, but my price is 91.50. Now I was risking this $1 here, and it starts as a day trade, it closes well, it becomes a swing trade, and I make $5.50 a reward on that. Or even better off this 30-cent risk spot. So I hope that helps, Mr. Cool, and that would be my feedback for you on it. And it's a great question that everyone can learn from on kind of combining the information we have on the morning meeting with execution. Yeah, no problem, Sean. Yeah, very very similar to the 5-minute Micron there. Was calling out this potential pivot low here in Rivian, which gave a 15-minute correction when the market was weaker also, which is natural. Nice little inside 5 for continuation here off of that deeper correction as that happened too. All right, gang, it is 10 after 5 Eastern time. Again, I apologize about the technology issues there. I'm going to try to work all that stuff out with the tech team, but I'm not great at technology. So choppy day today. I hope everyone was able to kind of defend themselves well, because that's what you need to do in a day like today. And we'll pick it up tomorrow. We'll see how we gap. Have a great night, everybody. turn this off? I gotta do that. Whoops. Using